I am Michael from Jamaica. Hey, today's video is all about investing in the ETF and what we should consider. Hey, if you are interested in this topic, then stay with it. Here we go. Hey, basically, buying an ETF only makes sense, if you are planning a long-term investment. Of course, you can use ETF for your daily trading or for short-term investment horizon. ETFs such as SPY, S&P 500 or the XLE US energy sector are good examples of this. But only with a long-term investment horizon can an ETF develop its full potential. Hey, ideally, you should stay invested in an ETF for at least 10 years, man. An investment horizon of 15 to 20 years is even better. Statistics show that the longer an ETF investment horizon is, the more likely it is to make a profit, regardless of how large the price fluctuation were in the investment period. That makes ETF an ideal retirement plan. Yes, man. But in order to get the most out of an ETF, you should make a one-off investment. It is better to make a small base investment, let's say 200 or 1,000 or more, and then deposit money every month like 50, 100 or even more. No, why doesn't a one-off investment make sense? Because statistically, you always have to expect strong market corrections over a long period of time, man. If you have invested once at a high point in the market, which you can never know before, and later there's a major correction, it may be after 10 years that your investment is smaller than at the beginning. That can happen, but does not have to happen. Hey, but if you invest money in your ETF every month, the ups and the downs kind of balance out over the course of 10 years. Herewith, you are on the safe side. Yes, man, so that you can expect a continuous return. In order to further improve the performance of your ETF, you should consider carefully whether you are invested in a dividend-strong ETF, an ETF with strongly growing stocks. You see, companies with high dividends are often very solid companies, but their future growth will be very limited. Think of Coca-Cola, ExxonMobil, or Home Depot. Why should a company that distributes 2 to 4% dividends a year not be good enough for you? Because the dividend is only half of your possible return, man. You see, business growth is the other half of your return. In contrast, there are promising, strongly growing companies such as from the areas of IoT, biotech, or e-mobility. But for most of these potential growth companies, they don't pay any dividend. So what should you do? Fortunately, there's an ever-increasing number of ETFs. At the moment, there are around 6,500 different ETFs worldwide. Hey, I recommend an ETF that includes companies that are both fast-growing and pay dividends. There are some ETFs that fulfill these requirements depending on where you want to be invested. Example, USA, Technique, Worldwide, Asia, etc. You can make a choice. Hey, you see, companies that can increase their value tenfold and pay dividends will turn your ETF into a rocket. Hey, incidentally, you see, for your research, I recommend ETF database and just ETF. I have packed the corresponding links under the video for you, so go check it out. Hey, what else is important? Always orient yourself to the 2 to 4 ETF with the largest market volume within the desired segment. ETF with small market volume may be closed in crash times, and your investment will be lost. As the saying goes, names and sound and smoke. That means even if the ETF is called world, the shares of global companies are often only a few percent. Hey, the iShares Core MSCI World ETF examples include 63% companies located in the USA. Maybe you can imagine a world ETF to be a geographically diversified ETF. So look at the ETF, which companies are listed with what percentage. This is especially important if you have several ETF in your depot. Otherwise, it can happen that you have 3 different name ETF in your depot with the same companies. Before I forget, a very important point for choosing your ETF. You see, some ETF pay the dividend directly to you monthly, quarterly, or annually, while other ETFs automatically reinvest dividend into the ETF. This reinvestment of dividends is recommended. You see, with the help of the compound interest effect, you can significantly increase return on your ETF. Hear me now. If this video has brought you any intellectual added value, please leave a comment. We are also happy to answer any criticisms or suggestions. And remember to subscribe to our channel and benefit from our knowledge and experience on the way to your financial independence. Yeah, man.